Welcome to Chart Trading Pro's video of the week. This week's training topic is simple trading methods, tools to help you become a better trader. I'll take you through a little walkthrough of charttradingpros.com and show you how to get to our live chart room. When you pull up charttradingpros.com on your computer, this is the home page that you'll see first, and up here at the top highlighted you'll see trading, frequently asked questions, calendar, blog, students, our privacy policy, and how to contact us. On this home page, if you read it, it'll give you some interesting facts about Chart Trading Pros and why we've chosen to do this. And if you scroll down a little bit, you will actually see a little spot to put in your name and email right here. Just enter in that information and we will send you a link to our chart room. Now, going back up to the top of the page, you'll see the calendar tab. Go ahead and click that. Alright, once you click on the calendar tab, you'll see this calendar come up, and it's divided by weeks for the current month that we're in. So for July 1st, which is a Wednesday, you will see that we'll be in the chart room at 6 a.m. for the European Open and 12:30 for the New York Open. These are all GMT time, which is a time zone in Europe. To find out what time GMT time is, just click on the link above there and you can put in your current time information and it'll convert it to GMT time for you. You can find out the difference. Those are the times that will be in the chart room. Sometimes it's just for the Open, sometimes it's just for news, whatever it may be. We took off for July 4th, even though the market was open. We weren't going to be in the market. So this will tell you when we're in the chart room. Now below that, in the same box, you'll see the word PIPS on July 1st, and for the first 3 weeks the password is PIPS. That's the password you're going to need to type in once you get to our chart room and you enter in your name and email. It'll ask you for a password. That's where you can find the password to get into the chart room. It's a temporary password, but that'll get you in to check things out and see if this is something you want to be a part of. Next, if you scroll down a little bit, you will see our results of the called trades from our chart room. We began doing this in February, and not for the whole month, but like the last week, and then we had March, April, May, and June. You can see we've done between 14 and 1500 pips every month consistently. This does also include our negative trades. So these are positive trades that we've done, collaboration of both added together. We average about 14 to 1500 pips called out every month. And you can see from a mini account how much you would make, and from a standard account how much you would make. Not bad for a few hours worth of work every day. Next, we'll start our training for the simple trading methods, tools to help you become a better trader. Alright, the first tool we're going to talk about is a moving average, or MA. What is a moving average? An indicator frequently used in technical analysis, showing the average value of the security's price set over a period. So if we have a 8 moving average, it would be the average price over the previous 8 candles. Moving averages are generally used to measure momentum and define areas of possible support and resistance. Moving averages are used to emphasize the direction of a trend and to smooth out the price volume fluctuations or noise that can confuse interpretation. Typically, upward movement is confirmed when a short-term average crosses above the long-term average. So if you have a 15 moving average and a 50 moving average, when those two lines crisscross, that would show that you're going to get into a trend, either upward or downward. And that is a moving average. Alright, next up we have Bollinger Bands. Bollinger Bands are one of the most popular technique indicators for traders in any financial market, stocks, bonds, foreign exchange. Many traders use them primarily to determine overbought and oversold levels. Selling when price touches the upper Bollinger Band and buying when it hits the lower band. In range-bound markets, this technique works well, as price travels between the two bands like a ball bouncing off the walls at a racquetball court. Even yet, John Bollinger was the first to acknowledge the tags of the bands are just that, they're tags. They're not signals. When price hits that upper band, in and of itself doesn't mean to sell, just like when the price hits the lower band, in and of itself it does not mean to buy. Price can often and does walk the band. In those markets, traders who continuously try to sell at the top or buy at the bottom are faced with the excruciating series of stop-outs or worse, an ever-mounting floating loss as price moves farther and farther away from the original entry point. And if you go back in history and look at some Bollinger Bands and some pricing, you can see that it will walk that line, and you think you should have gotten in or gotten out. And you know, it's a reference point, it's a tool, it lags just like all the other indicators. Those are Bollinger Bands. Next up we have Fibonacci retracements. Fibonacci is a very popular tool used by many technical traders to help identify strategic places for transactions to be placed, target prices or stop losses. What does Fibonacci retracement mean? A term used in technical analysis that refers to the likelihood that a financial asset's price will retrace a large portion of the original move and find support or resistance at the key Fibonacci levels before it continues in the original direction. These levels are created by drawing a trend line between two extreme points and then dividing the vertical distance by the key Fibonacci ratios of 26.3%, 38.2%, 50%, 61.8%, and 100%. There are a lot of individuals out there. You can look some up here on YouTube that do Fibonacci constantly in all of their trading. For us here at Chart Trading Pros, Fibonacci is a great retracement tool, but as far as predicting where the market's going to go and stop and start up again, Fibonacci really can't do that. It's going to tell you that it may stop at the 61.8 mark, a 50% mark, 23.6 mark, but not necessarily always does. And if you go back and look, you can see it worked here, and there's some instances where it hasn't worked. It's a great tool to tell you what has happened, but it's hard to use a retracement tool like Fibonacci to tell you what is going to happen. So the last tool I want to talk to you about is having a mentor, and Chart Trading Pros can be that mentor. If you're an experienced trader looking for a little insight on how we trade, check us out. If you're an inexperienced trader wanting to learn how to trade, check us out. There's no cost to you whatsoever. You can watch us for a short amount of time, see if this is something for you, see if you like our ways, and join our group. Well, that's it for today at Chart Trading Pros. We wish you happy trading, and we'll talk to you next week. Have a great day.